Welcome back, everyone. And in today's video, what I'm going to be sharing with you is our Trading Wins Victory Method. This is a proprietary strategy that I designed a while ago and I've been trading with for the last few years. And it is really something that's been working very, very well for me. Let me tell you a bit about it. It's based solely on technical analysis, but what it does do for you is ensure two things. One, that you're trading with the current trend and a trend that has momentum with it. So with trend and momentum on your side, the odds of success are highly in your favor. And that's what we're trying to accomplish with this and what we did accomplish with this. So let me get to the charts and show you exactly what this is, how we use it, and how you can use it to better your trading. So again, it's based solely on technical analysis. It will tell you exactly where to enter, where to exit, when not to be in the market, etc. But you can use this on stocks, futures, for crypto, any time frame, whether you're a day trader and say trade on the minute, 3-minute, 5-minute, 10-minute chart, whether you're more of a swing trader, trade on the daily, or whether you're more of an investor, trading on a weekly or a monthly chart. It really doesn't matter. And you can trade commodities, futures, forex, like I said, anything and any exchange in the world. We have tested this in North America, the UK, Australia, Singapore, you name India. It's technical analysis. It works the same across the board. So let me show you what you're looking at on the screen here and what we do with these signals. So obviously there is a grouping of indicators behind the scenes that when they align, you get these signals. Now, you'll notice there are three types of signals. There's buys or sells. There are what we call re-entries, and you'll see those on both long and short trades. And then there's exits. Now, you'll see clearly these signals are marked. So when you get a buy, the candles will be painted green. And for the life of that trade, they will be painted green. They will not change colors along the way. And that is done for a specific reason, to help you remain disciplined. In other words, how many times have you opened a trade to the long side and seen it go in your favor for a while, but as soon as you get one or two red bars, you start to question yourself and wonder, is this about to turn on me? Am I about to give back my profits here? And so to avoid that, what we do is keep every single bar painted the same color. So if it's a buy, we paint them green until we either get a sell or an exit. And sometimes the trade will go immediately from a buy to a sell, and other times it'll give us an exit flag. So if it goes to a sell, the candles will be painted red, and they will remain red for the life of that trade. If it's an exit, they will be painted yellow, and they will remain yellow, which means don't do anything, stay out of the market until we get either another buy or another sell. All right. And so again, this is a weekly on the S&P 500, but what you can tell without even putting on any other indicators here or looking at anything else, what you can tell is clearly that when, we're in a long trend, it's telling you to stay long. And when we're in a period where the market is selling off, it's telling you to be short. So in other words, again, it's keeping you on the right side of the trend and clearly demonstrating when there's momentum and when there isn't. Well, for that, we're going to use one additional indicator that I'm going to put on my chart right now. And that is a plain, simple 20 period moving average here. Let me open this up for you here. The MA. There it is. A 20 period moving average based on the close. Simple moving average, not exponential, not weighted, nothing fancy, just a 20 period moving average. And the reason why I want to put this on there is to help us judge momentum. Now, the indicator will do it for you. So these buys and sells will do it for you. But I don't expect you to have the same level of confidence I have in these signals until you've been using it for a while. So until then, and to help you decide which signals you will take and which you won't, because the intent here is not to take them all. I will teach you exactly which ones to take and which ones to not take. But until then, the 20-period moving average will help guide you, will help you stick with the correct signals to take and the ones not to. And there's one simple rule, very, very simple. Look at the slope of the 20-period moving average. In other words, if you're going to trade to the long side of the market, if you expect prices to go higher, you want that 20-period moving average to be sloping upward from left to right. You want it to be sloping in the direction of the trade. And if the market is selling off and you're going to short this market, you want the 20-period moving average to be sloping lower, downward. So always in the direction of the trade. If you go through a period where it is flat, where the 20-period moving average is not sloping one way or the other, and there are clearer examples that I will show here, you want to remain out of the market or keep an eye on that consolidation phase, waiting for a breakout. So in other words, what I want you to focus on is to strictly take the signals where the slope is in the direction of the trade. So in other words, like this buy signal here, have a look at the slope of the 20 at the time. It was sloping significantly upward. Now, when I say significantly, I'm looking for about a 45-degree angle on that slope. That's what I would consider significant. Anything greater than that, even better. You could take even a slight slope, that counts as well. But about a 45-degree angle like this is what I consider to be very significant. And anything with a higher degree of slope, even better. So what we see over here is a very significant slope in your favor. What that means is there is a lot of buying pressure. There is a lot of momentum behind that trend. And a trend obviously can be spotted by looking at the pivots and saying we have higher lows and higher highs. That's kind of obvious. But, and usually here's a hint, if you're above the 20, if price is above the 20, chances are you have higher highs and higher lows already. Below it, you have lower highs, lower lows. It's a very good indicator to use just to make sure you're on the right side of the market. But the slope matters quite a bit, especially with the victory method here. So let's say we get a buy signal here. The first thing we do is we want to make sure that the 20-period moving average is sloping in the upward direction. If that's the case, then we can go ahead with the trade. We also want to make sure that we are opening that trade somewhere near the 20-period moving average. Sometimes, you might see a gap, right? And price might be up here when you get the signal. Well, being too far away from the moving average is not a good thing. That presents more risk for us, because whenever price moves away from the 20, it will always snap back, right? It moves away, it snaps back. It snaps back. That's the same for any moving average. So when you're using a moving average, you want to enter the trade near, as close to the moving average as possible, not very far away. But let's play this out. So we enter this buy here, we go long. Now, it's going in our favor beautifully, just as we expected. Why? Because we already have a strong trend and we have very strong momentum on our side. Now, it pulls back a little and suddenly we're presented with what is called a re-entry. Now, the reason why we label this a re-entry is because we are already in a long trade, but the same criteria that came together here to signal a buy has come together again here. In other words, those indicators, that group of indicators in this formula, in this algorithm, have realigned again. They had gone out of alignment on that pullback, have realigned, and are signaling another great spot to enter long on this chart. But because we're already in a buy, we label it a re-entry. So the thought here is that if you're a conservative trader, do not want to take a lot of risk, you enter here, and here you do nothing more than continue to hold. I mean, in other words, you use the re-entries as further confirmation that you're in the right trade and should remain in that trade. If you're a little more aggressive, what you want to do is add to your position here. So, say you bought 100 shares here, you can buy another 20, another 50, another 100. the sizing depends on you and the size of your account, but you can add to your position. So if we bought here, we add here, we add here. Then whether we get a sell or an exit, any change in color is telling us to get out of that trade. Now, here's another thing that I want to tell you. It's always a good idea to scale out of your trade along the way. In other words, when you have a winner like this, yes, you can hold on right up until the end, absolutely up to you, but it's always a good idea to sell a bit along the way, because you never know when you might get a big gap against you. Have a look at back here, right? We had a nice entry here. We had a nice re-entry. So we bought, we added to our position. We had another re-entry. We added some more. And then out of nowhere, we had, boom, a big move lower, right? This was actually a gap down. This is a weekly chart, but it was a big move lower. So if we had scaled out along the way, some of our profits, we wouldn't have given back as much as we did here. Now, this is rare. Gaps are rare, but they do happen. So that's just a friendly tip. But otherwise, if you follow the signals, and by following the signals, I mean following the rule of having that slope in your favor, what you should find is that not only should you have more winners than losers, but your winners should be much greater than your losers. The reason being is as soon as the algorithm senses that it's going against us, it usually gets us out very, very quickly. So not only is it great at predicting the start of a nice move, it is also very quick to get us out here should things start going in the opposite direction. So it is a fairly safe strategy. Now you see here, it told us to sell, right? But what direction is the 20-period moving average sloping in? It's sloping higher, not lower, is it? So it's not in the direction of the trade. So we do not go short the market. We just simply exit our long. Now, we get an exit here for that sell signal, which we weren't taking anyway. Bars are yellow, we do nothing, right? When bars are yellow, you stay out of that market. Then we get a buy. What do we do? First thing, we look at the slope. Is it sloping in the direction? Yes, it is. We enter again, right? We get a re-entry. Is the slope there? Yes, we enter again. And then we get a sell. And now we go flat. So on the sell, do we go short? It's flat, isn't it? It's not sloping in our direction, right? So we do nothing. So we ignore it. We get a buy here. What direction is it sloping in? It's going against us. It's not, for a buy, it should be sloping higher, but instead it's sloping lower. So we do not buy there, correct? Now on this next sell, it's sloping downward in the direction of the sell, which we would take. And then boom, there it is. So if you follow that one simple rule, you will do very well with this strategy. Now let me show you a couple of other examples. Let's look at Crocs. Now Crocs, had a phenomenal run here from early 2020 up until, well, pretty much the end of 2022. That 2-year period was a phenomenal run. Now, look at this buy signal here, right? It's sloping lower. Do we take that? No, we don't. Now, there are many other ways we can judge whether we want to enter long or not. Throughout the course, the different videos that you watch, we will go over several topics that will help you understand when is the right time to get in, when is not. But if you're strictly following this, even though this had such a great run here, to enter when it's sloping against you is very, very high risk, and I wouldn't recommend it. I do not do that. I would not enter here. But would I enter here? Absolutely. Would I enter again here, and here? Absolutely. So in this case, I would have entered here, added, and then exited. That's simple. Now, this is the weekly chart. Let's break it down to a daily. So now let's zoom in a little so we can show you a few other things here. Here's a great example right here. And I want to take this and mark it. So right here, have a look at this phase in here. You see how many buys and sells are in here and exits? we would skip all of those. Why? The 20-period moving average is flat. There is no slope, not lower for short sales, not higher for buys, right? Just following the slope of the 20 will allow you to skip all those choppy areas. And this is where most traders lose all their money, right in here. You know, they pull off some great trades, and then they run into a period of consolidation, whether it's an index chart, whether it's a single stock, a Forex pair, anything like that. And in here is where they buy, right? They get stopped out and they lose. They sell and they get stopped out and they lose, etc. Back and forth. So we want to avoid all that. That's why you want to pay attention to the slope. Now, if you really want to play the consolidation areas, what you should do is mark the highs and mark the lows, or box it like I did here, and wait for a move out of that channel, one way or the other. If you get a move, a close above it, you go long. If you get a close below it, you go short. Now, this was a gap. Like I said, never want to enter far from the 20. So we don't. So we sit tight and we wait. Now the signal's in here, again, pretty flat. But then what happens here? We get a buy. We have slope. Yep. And there it is. We re-enter. Boom. Sell there. Nice profitable trade, right? Do we take that sell? Do we go short? No. Why? The moving average is going against us. It's sloping higher. We want to slope lower. So we wait patiently. We get a buy. Is it sloping higher? Yes, we enter and boom, there it goes. So the combination works exceptionally well if you're disciplined and follow the rules. The good news is the rules are so simple, kind of hard not to get them correctly. Look at this. Once Crocs here went out of favor, what happened to the moving average? It started sloping lower. Look at the signals for the slope lower. Would you have taken this sell? No, it was sloping higher. The reentry tells us, yep, sloping lower. We want this. We get in. Boom. Look at that winner. Enter here. Slopes, we add to that position, continues to go. Then it pulls back and we're out of there. We exit. Whether you're watching the buy signal here, which of course we don't buy because it's sloping against us, our exit, we wait, and then we get a sell. Slope with us, yep, and we go again. Boom, another winner, and another winner, etc. Consolidation area, right? What do? We do nothing. It's flat. What do we do when it breaks below or above it? There you go. There's your signal. You go short, etc. It is super simple to follow, and I can show you example after example after example. But it works extremely well. And like I said, whether it's an index, whether it's a single stock, a futures pair, anything like that. You want to look at crude oil futures, focus on the signals with slope. That's it. See, these have slope, runaway winners. Slope lower, winner, right? Areas of consolidation will chop you up every single time. Now, is this perfect? Is it going to be 100%? Absolutely not. You will have your losers, but you should feel, in time trading with this, you should feel very comfortable, because you'll notice that when it does not go well, it exits immediately. So your losses tend to be very small. Is it possible that, there'll be gaps against you? Of course. That's a part of trading. You can never prevent that or anticipate it. News events are news events. One thing you can do to avoid that, though, is not trade through earnings. An earnings event will usually cause a gap. So be aware of the earnings date and make sure you're out of that trade before that earnings announcement. Plain and simple. But again, this is based solely on technical analysis, works on any market, any time frame, and keeps you not only in the right trend, but in the trend that has momentum on your side. And that is how you become a successful trader, a consistently profitable trader. Thanks again. We'll see you in the next video.